Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I'll just let you have a look at a couple of disclaimers, I'll just run through what we hope to get through in the next 30 to 40 minutes or so. We'll follow our usual format, so we'll actually just check out how markets are shaping up currently. We'll then look at equities in a little bit more detail and see what is happening with this sell-off that we've been seeing in the last couple of days. We'll then review last week's main data points, that being the US CPI data and also the ECB meeting. We'll then look at this week's data, which includes that bunch of UK numbers, important numbers, the inflation numbers out earlier today and the wage growth data out yesterday. We'll look at that in detail, as well as look at, hopefully, if we have time, the upcoming Japanese CPI data. So fair amount to get through. I'll just let you have a look at these disclaimers. As I say, at the moment, markets, well, sort of slightly nervous, really, obviously, after the weekend's activity in the Middle East and, of course, the Iranian missile attack really on Israel. An attack, yes, is the word really, whether that was just a sign from them, of course, and what Israel's response will be. The sell-off momentum in stocks actually has slowed for now. So that is encouraging for the bulls. We had a mixed session in Asia, but European stocks have actually picked up this morning. Last time I looked. Interestingly, we had ASML Q1 results. That is the big Dutch chip maker, massive Dutch chip maker, I should say. Really, those results disappointed with bookings lower than expected, but they did maintain their midterm goals presented in their previous capital markets day, pointed to a stronger half of this year versus the first half. The stock actually has recovered slightly. It was down pre-trade, down around 8% actually at one point, but now it's just off below 4%, I think. Last time I looked, 3.77% or so. FX, the dollar upside momentum, slightly subdued today, near obviously it peaks after it hit a fresh 5-month high yesterday. Treasury yield spiking really after Fed Chair Powell signaled policymakers really in no rush to cut interest rates. Remarks that represented that shift really in his message after a third straight month where inflation exceeded forecasts. We'll look at that in more detail shortly, of course. Commodities, the stronger dollar, really amid surging treasury yields has created some headwinds for commodities yesterday, at least crude and gold, really though cushioned by heightened tensions in the Middle East. As I say, markets continuing to monitor Israel's response to the weekend attack. Gold really very much cushioned and sort of heading towards $2,400 again. If we just actually, I'd like to pull up that chart because certainly gold has been an outstanding performer over recent months really, and still powering ahead. You can see it just at 21.91 at the moment, so up a third of a percent or so. Still we have that spike, which we thought was a bearish candle really. You can see we spiked up to that record high at 24.31 and then closed near the lows of the day. That was on Friday actually, so a weak close on the week. If we just show you that candle there, you can see it did close higher, but still much closer to the lows, but it did close higher. Certainly if it had closed lower on the week, nearer I guess its lows, then that would have been very bearish for us, a sort of shooting star candle. But anyway, we continue to move higher closes, you can see. And yesterday though was interesting with the doji, so sort of denoting a little bit of indecision between buyers and sellers really. But today you can see we are moving higher again. Oil, just to look at that briefly as well, off, interestingly off. You can see we sort of got up to sort of 91.65 or so. This is in crude, the high, sort of 5-month high on Friday, just beating that earlier April high at 91.57. But you can see that candle, really a shooting star. So shot higher and then closed very much closer to the lows, on the lows of the day. So bearish really. And you can just see now we're just moving lower now, below and away from $90, potentially below this week's low, which was at 88.23, which means then there's not that much support for us until you get to sort of where are we, 87 bucks or so. That's on crude potentially, if everything calms down, of course, in the Middle East. Fixed income, so that's treasuries. US policymakers really sticking with this higher for longer stance. This is crucial really in markets going forward, this central bank divergence theme. 2-year yields, if we just look at those, so treasury 2-year yields, they closely map Fed funds futures. We look at 10-year treasuries a lot, so that's a sort of global proxy for borrowing costs, if you like, but the 2-year yield for sure, that tracks Fed funds futures, as I say, very closely. You can see we're just sort of just below 5%, that key psychological level, not really a technical level, I'd say, but if we do break 5%, then obviously we're looking at these highs from last year, sort of around 5.2%. That looks like bullish consolidation, sort of flag consolidation pattern to me, but yes, 5% will prove resistance, and it has proven resistance over the last few days. Just watch that really. If we, as I said, if we do go and carry on with this sort of bullish momentum, then we break 5%, and then we get up towards 5.1 and 5.2% potentially. So at the moment that looks like bullish consolidation before we break 5%. Otherwise, sort of support around 4.86%, so we can consolidate here for a while and just waiting for some catalysts. That could be, there's not that much US data out until the key number will be the US core PCE data out next Friday, 26th, which is the Fed's favored inflation gauge, and markets will seriously be looking at for what the Fed does going forward. We'll check out that in more detail, as I say, shortly. Just on that central bank divergence play as well. That was in play for sure yesterday, highlighted really by two speeches from both Fed Chair Powell and ECB President Lagarde. The former, basically, he said, or he signaled tightening for longer effectively, while the latter, President Lagarde, confirmed that the ECB is ready to cut rates soon if inflation keeps easing. So that is the key theme for us, the key narrative for markets at the moment, which is a central bank divergence play. As for stocks, if we just go to those now, this is the S&P 500. Well, just before I get to that, actually, I just want to focus on the VIX. So the VIX we haven't looked at for a while, actually, which is sort of a sign of the times, but now we're looking at it because it's picked up. The VIX, obviously, well, not obviously, but for you guys not aware of it, it's essentially Wall Street's fear gauge, it's known as. So it's real-time market index, really representing market expectations for volatility in the S&P 500 over the coming 30 days. And that's basically derived from prices of S&P index options with essentially near-term expiration dates. But aside from that sort of calculation, it represents volatility, often seen as a gauge of market sentiment for sure. And as I say, generally known in the popular press anyway, it's kind of the fear gauge on Wall Street. Long-term average, and this is probably why we're mentioning it, is around sort of 17 or so. So anything above 17, anything towards and above 20 is where we see volatility pick up. If you just look at the weekly chart, you can see how low volatility has been. We've sort of been sub 15 for most of this year and going back into Q4 of last year. So very, very low volatility. But now you can see that just picking up now. That's the 200-day moving average, actually, the black line, 200-week, sorry, moving average, the black line. And you can see, where prices are above that, then we're it's sort of a lot more volatile, whereas these periods that we get below that and then below that long-term average of 17 is interesting. We're just ticking up sort of towards 18 now, and we sort of spiked close to 20 earlier, well, yesterday actually. So just watch out for that. Interesting gauge for you to monitor. Obviously, this spike has been generated by the geopolitical tensions between Israel and Iran, of course, pushing up commodity prices. Aside from that news, we do have, of course, the unfolding Q1 earnings season. That's sort of potentially driving market fluctuations in specific stocks, at least. Just looking at that, we've had Goldman Sachs, which were decent results on sales and trading, really. Charles Schwab, not so good. They were on Monday. Then yesterday we had Johnson & Johnson, Morgan Stanley as well, big US investment bank. They were positive again on the wealth management side of things, so a sort of slightly less volatile area of the bank, really, for revenues at least. Today we had ASML, as we've gone through. Tomorrow we do get Netflix, which could be of interest, of course, a big retail stock. And then Friday we get Procter & Gamble and Amex, American Express. Expected moves for the coming week. Well, at the start of the week, they were for the S&P to move around 1.75%, and the Nasdaq just under 2%. So, yeah, we're getting that movement for sure. As I said, well, no, just looking at indices from yesterday, then they fell in Asia and Europe at least quite sharply. And we just sort of moved a touch lower on Wall Street as well. We had those strong US retail sales figures really suggesting the Fed might cut rates, well, for sure this year by less than previously thought. Just on the European indices, yeah, so the Euro Stoxx 600, that fell by 1.5%, its biggest one-day drop since last July, in fact. And then the FTSE in the UK, the FTSE 100 fell by 1.8%. That was also its worst day in 9 months. We're just sort of getting a bounce back. You can see this is the UK FTSE, big drop down, nearly 2% down. We're just getting a sort of reaction to that, kind of inevitable. You can just see them sort of resistance support around sort of just below 7,800 really. We just sort of tapped that and we bounced off it. So it'll be interesting here. That 50-day moving average, that's at 77.62. And then you can see long-term level there, the big dotted line just above 8,000, which we tapped last Friday, and then obviously collapsed really since then. So interesting point for the FTSE. Just on Euro Stoxx 600, you can see the all-time high there at above 500, and we're just now tapping 500 and that 50-day moving average as well, just around that 500 level. So an interesting level on the Euro Stoxx 600. As for US indices, so yes, the S&P closed down 0.2% on the day yesterday. Nasdaq slipped 0.1%, but that follows steeper declines. In fact, the S&P actually recorded its worst two-day streak on Friday and Monday. That was the worst two-day streak since actually the regional banking crisis in March 2023. So just on the technicals, I'll just take off the Keltner channel here. You can see, yeah, we just broke down below. We had the support around 51.46. You've got the 50-day moving average of 51.16, just broken now down below that. We've got a near-term, sort of long-term fib level, if you like, of this move from the October low. First retracement level just below 5,000, 49.90. Then we have the 200-day moving average at 49.21. So, yeah, interesting levels potentially if we do carry on down lower. For the Nasdaq, we've broken out of this uptrend, this bull channel, broken down through the 50-day moving average, just below 18,000. So really, we've got that swing low there. A 17,319, and then just above that we've got the 200-day moving average, interestingly, at 17,320. So 500 points away or so, and we haven't really touched that 200-day moving average since late last year. So interesting point for the Nasdaq potentially, and certainly it's this rising yields that we think, you know, if these continue moving higher, then this will impact on stocks eventually. And of course, that risk premium is in there from the geopolitical tensions in the Middle East. Just checking out the Dow as well, that's moved lower, more than the Nasdaq and the S&P. Less tech in there to hold it up, but of course those are now catching up. We've got the 200-day moving average actually, interestingly, for the Dow, which we're trying to sort of track around. Yeah, you can just see on the futures, we're just trading around that black line, which is a 200-day moving average. On the cash, it's just below 38,000. So interesting level, really. I've got fib levels in here from the move this year. I'm not sure how really relevant they are. But the 200-day moving average, interestingly, yes, just watch that level, 38,000. Otherwise, we've probably got these swing lows around just above 37,000, 37,132 as a sort of level of support potentially if we carry on moving lower. Okay, those are stocks. If we just move now to, first of all, the data from last week. Really important data, of course, really important to just dig into this in more detail. We think US CPI data really surprised to the upside again, really driven by low 2023 base effects and then very current strong price dynamics. It really seems that January and February, which are of course sort of characterized as a seasonal blip, really they're not a blip really. The March headline printed at the monthly at 0.4%, so above 0.3, the core at 0.4 as well. Consensus again expecting 0.3. That's really especially worrying for the hopes of a Fed rate cut. Was the fact that the broader core services drove the upside surprise. So services ex shelter at 0.8% month on month, and then the super core number, which is what the Fed really look at. So that's services ex energy, ex housing, that rose 0.65% month on month. And that really tallies well with recent signs of continuing strong wage inflation and, of course, the tight labor market that we've been seeing. And really then underlying price pressures not only remain too high for comfort, but actually show signs of accelerating in, well, the first quarter of this year. As we say a lot, we really need month-on-month prints of below 0.2%, 0.1%, I think economists say, sight is really being needed for a prolonged period to bring us down to 2%, the 2% target year on year. So we're running really at double that pace at the moment. Those are all the numbers. I've pretty much gone through those as well. Sticky shelter costs make up certainly half of the total inflation headline number at least, and they are expected to impact on that headline potentially going forward, but they are taking time, and they are notoriously known to lag, certainly, but they are taking longer than expected, of course. As I say, it is that super core number, so it's the services inflation number, ex housing, ex energy, which is worrying for the Fed going forward. Of course, if we just track this, these are the sort of the chart before we got those numbers, and these are just proving now sticky. We do have in there, sorry, the green line, which is the core PCE number. So that is that number that I said is released next Friday. And interestingly, PPI data, which feeds into PCE data more than the CPI basket for sure, of course, which doesn't have that. That then influences that PCE number going forward. And the PPI data was weaker than expected. So just watch out for that difference as well with the CPI data compared to the PCE data, which is what the Fed prefer to look at. Let's just check out the DXY actually, which is the dollar index chart. Sorry, just bear with me 1 second. Which is here. So that data was, of course, last week. And we can see then the big move, market reaction to this US CPI data really. 10-year yields, they gained 18 basis points on the day. They pushed towards them 4.5%, and we've obviously gone higher then since then. The greenback on the day, that jumped 1% against really every G10 currency, and of course broke through this 105 sort of resistance level that we had mentioned previously. Euro dollar, that posted its biggest one-day drop since March last year. And then, of course, dollar yen, if we just look at that, although we'll look at it later, but where is dollar yen? Sorry, that broke through 152, that barrier really of the intervention level that we had seen in October 2022, and then obviously hit that level last October as well before pulling back. Well, we surged through that level and of course have gone above 154 since. Just on the dollar index though, and the CPI report anyway, we do have two more jobs reports, two more CPI reports before the June meeting, but certainly now that June cut is pretty much off the table. We probably need payroll growth of sub 100,000 really on the headline probably, and we'd need those month-on-month prints coming in CPI really below 0.2%. We're not probably, certainly most likely not going to get that, and the last CPI report is actually on the day of that June 12 FOMC meeting. So yes, big ramp up in the dollar certainly. We've moved now above 106, and you can just see now that fib level, we've moved above that as well, which is the Q4 retracement level. So we've got these levels around 107 now, potentially that we're looking at now. We're above 106, and if we can stay there, you can just see we're slightly overbought on the RSI, sorry. Now I'm just putting on the Keltner channel. We like to use this, and we're just overbought. So you can see that through that Keltner channel there as well. So just watch out for some pullback, potentially technical pullback, really, as much as anything, because ultimately this higher for longer stance really is potentially going to underpin support for dollar in the near term at least. And then, of course, as well, these heightened geopolitical concerns really add to dollar support in the short run. June rate cuts, they are off the table now. If I just show you the CME Fed Watch tool, which we like to use, hopefully you guys are looking at this as well. This just shows us Fed funds futures for the specific Fed meetings. Let me just double check. You can see that. You can. And you can see the May meeting certainly on hold, and then as well the June meeting now 85% chance we stay on hold, stay at 5.25 to 5.5%, and you can just see even a month ago we were half that, 41%, 60% we were going to move, and then of course if you go further out we were sort of nailed on way back in January, nailed on for a rate cut in June, and more actually. So yes, less than a 20% chance of a rate cut in June. July, last time I looked, yeah, okay, so 57, 43, 57 on hold basically, and we don't get the chances of a rate cut, until September, and you can see sort of 70-30, so 70% chance just under of a rate cut in September now, and ultimately markets pricing in just under 25 basis point cuts for the whole of this year. And certainly that contrasts if you take your mind back to January with over 150 basis points of rate cuts. So obviously that is support for the dollar, and potentially is that going forward as well. Interestingly, we had US retail sales on Monday, very strong, topped estimates, really pointing to this continued US economic resilience that we're seeing in the data. Headline retail sales, they rose 0.7% versus 0.3, I think it was, forecast. down from the prior, but upwardly revised 0.9%. And really all those other measures in retail sales, they showed really widespread gains across consumer spending. The control group, which that feeds basically directly into US GDP, that rose 1.1%. So accelerating from, again, prior 0.3% and above the 0.4 expected. So very strong report, and really pointed to no rate cuts in the very near term in the next few months until after the summer, really. The Atlanta Fed GDP now growth estimate, that has risen now for Q1 from 2.4% to 2.9%, I think it is. Last time I looked, 2.8% it went up to after the retail sales, now at 2.9%, that guide for GDP for the first quarter. Should also mention, while we're on it, those comments from Fed Chair Jerome Powell yesterday. He said basically the recent data have clearly not given the Fed greater confidence and instead indicate that is likely to take longer than expected to achieve that confidence for a rate cut. Really his remarks echoed other messages from Fed officials about the shift of the Fed's stance towards postponing the start of the easing cycle to later than July. And that really sets up, just those two, possibly less rate cuts now for this year as a whole. Of course, we do get the US election as well on the 5th of November. So interesting, just sort of 3 meetings potentially if we go unchanged through the summer to then. There's no meeting in August, you can see, through till September. We just have 3 meetings left with a US election in between, just to add to the mix for the Fed's decision making and potentially rate cutting or not. Okay, let's move on now to what else did we get last week? We got, of course, the ECB meeting. I've just got in here the Eurozone inflation chart. Nicely falling inflation. Price pressures, as I've said, continue to ease, continue to support a June rate cut. So the ECB, they kept measures unchanged, of course. Inflationary pressures have, though, further decreased, really enabling the ECB to be pretty much quite explicit about their next steps. They said if the Governing Council has updated assessment of the inflation outlook, the dynamics of underlying inflation and the strength of monetary policy transmission were to further increase its confidence that inflation is converging to target, it would then be appropriate to reduce the current level of monetary policy restriction. It was actually the first time the ECB had talked about rate cuts in that sort of in that guise, really, in its official policy statement as well, since the tightening cycle first started. So sort of symbolic move there. The assessment, the bank's assessment of the economy really didn't change that much since the March meeting. And in fact, the central bank acknowledged the easing of inflationary pressures as well as moderating wage growth, while at the same time, of course, stressing still strong domestic price pressures. Then during the press conference, President Lagarde, she repeatedly stressed the hint at an upcoming rate cut, but also as it, of course, the ECB was not pre-committed to any path for policy rates. She did mention, though, that a few ECB members had already been in favor of a rate cut, but ultimately, then this meeting, as I say, symbolic sort of gradual transition of ECB communication from sort of being hawkish in December to now being mildly shifting to this dovish stance. They didn't give explicit guidance really for a June cut, but certainly that is the thinking now. Of course, there is the hawkish element of the Governing Council to consider, and there is potentially quite a lot of disagreement within the central bank. Then the hawks really conscious of high services inflation, high oil prices as well, and then plus, of course, the sticky US CPI data we're seeing at the moment. Again, can't stress enough about this divergence theme that is in play now. Host of speakers, ECB speakers, basically talking about the June cut. As I said, Lagarde did as well yesterday, potentially, and then that contrasts certainly then with US monetary policy. I think we do get Lagarde speaking today, actually, in Washington, I think. But yes, divergence is key at the moment, and that is driving euro dollar lower. If we just grab the chart for euro dollar, we can see, I'll just double check you're seeing that. You are. So yes, we can just see now, big drop after US CPI data, sort of above, we were holding above 108, which is positive, above the 50-day moving average, but didn't quite beat the 200-day, that black line, and then the blue line plunged down below that, as I said, and then another big drop as well on Friday on geopolitical stance with sort of safe haven bids going towards the dollar. So we dropped down below the sort of year-to-date low, previous year-to-date low, which was at 106.94, and now we're just sort of teetering above, well, 106, and then this fib level from that Q4 rally just below 106 or 105.96. So possible support there. If we lose that, then we're going down towards 105. But we are overbought. We're just easing, sorry, oversold. We are easing those oversold conditions slightly with this uptick today. But yeah, a couple of days here would be bearish consolidation before then potentially a breakdown further if we can break sort of 106. Otherwise, we need to get back up above 107 really to arrest this strong downtrend now that we're seeing in euro dollar. Last week as well, just to briefly mention, we did get the Bank of Canada meeting as well. They kept policy rates unchanged at 5%. Since the January update, really overall financial conditions have eased. CPI key in Canada, and that's been slowing, cooling in price pressures really being quite broad-based now. Sticky shelter price inflation does remain an area of concern, but inflation is moving down below the sort of 3% level and is expected to reach target by next year for sure. Interestingly, the Bank of Canada, they did raise their estimate of the nominal neutral rate. You'll probably hear a lot about this now going forward. A lot of people talking about that after the Fed obviously raised their neutral rate 2.5 to 2.6%. The Bank of Canada doing it with their neutral rate going from 2 to 3% to 2.25 to 3.25%, and potentially the Fed might also increase theirs going forward. So just watch out for that as well. But for the Bank of Canada, yes, there were some dovish hints with labour market conditions continuing to ease, higher unemployment rate as well, helping to moderate wage pressures. And then at the press conference, Governor Macklem actually said explicitly a June rate cut is within the realms of possibilities. So really interesting sort of dovish talk from him directly. The dollar CAD, then that surged really to a new year-to-date high, so the CAD going lower effectively, with obviously dollar strength helping as well. Market implied probability of that June rate cut sort of did drop actually, but was owing really to a reflection of US CPI data, but is still pretty much getting towards being more likely than not, sort of 65% plus or so for that June rate cut. The latest Canadian CPI data, should mention, we did get that yesterday, and as I said, dropped below 3% to 2.85%, the median from a 3% expected, and the prior revised lower as well. It really was a continuation of the trend that we have been seeing, and really sort of put another boot in dollar CAD really. We got up to 5 month highs actually yesterday. 138.46. We're just overbought now, so just selling off now, sort of technical correction, you can see just overbought, but we are getting up to these levels which we haven't seen for a while, long-term levels which are sort of around and above 138 potentially, which will act as near-term resistance at least. Okay, moving on to this week, and data aside from that Canada CPI, we get a load of other CPI, including UK CPI, which we had this morning, and then other UK data as well, important being the middle of the month. Here's a review of the UK CPI data. Just before that, we did get important wage data yesterday. That's one of two key metrics the MPC, the Bank of England, use primarily to guide its policy making at present. They were, well, it was a mixed report really, but growth in average wages, weekly earnings, sorry, excluding bonuses, well, it moderated, obviously has moderated from a peak of 8.9% last summer, but it still remains sticky, 5.6% in February and 5.8% ex bonuses. So still pretty sticky. And that does sort of play into the hands of the Bank of England hawks for now, although obviously, or not obviously, but certainly a slowdown in the labour market is seen potentially in the coming months. As well, we should mention there has been a recent Bank of England survey actually, which has showed as well wage growth expectations falling to the lowest in 2 years. And so going forward, with the help of useful, helpful base effects as well, that should potentially see a decent acceleration in pay from last spring, where we saw those spikes higher in wage growth. That should potentially hit annual rates going forward and see them decline further in the months ahead. As I say, as for UK CPI data that came out earlier this morning, the headline fell from 3.4% in February to 3.2%, so that was 1/10 above estimates, but a fresh 2.5-year low actually. The core figure that declined again to 4.2% from 4.5%. That was its lowest print since December 2021, but was also 1/10 higher than forecast. So yes, the key metric there is services inflation. That again is closely monitored by the MPC as a key metric of domestic price pressures. That printed at 6%, so above the MPC forecast of 5.8%, and I think estimates were 5.9%. So that's, well, inflation got a boost from the early Easter holiday, don't forget. And last year's big price rises continue to drop out of the annual comparison. And as well, food and core goods prices also drag the headline lower. Those Easter effects should then reverse in April, which then will hopefully drag services inflation lower and much closer actually to 5%. With the MPC forecast actually at 5.3% for the April figure, which we get next time. Currently, sorry, just checking a couple of pricings here. So you can see then the chart here, falling prices, but just sort of sticking a little bit now or higher than estimates, but still this disinflation process is continuing in the UK, and potentially, well, April will be key for a June rate decision by the Bank of England. April will have potentially service sector increases, annual service sector increases hit the April figures. So potentially that may cause an uptick in the headline. But going forward then, they are expected to drop closer down towards 2% in the months ahead, with favorable base effects really helping those figures. Caveat against that would be higher petrol prices potentially, which will impact the headline CPI rate, but just obviously be aware policymakers really look at the core figure, which strips out those volatile energy costs, food costs as well. So it's only if then those higher petrol prices feed into second round effects really, and core data, which then policymakers would be wary of. If we just look at cable then, obviously that's taken a turn as well, similar to euro dollar. We broke down, you can see last Wednesday on the US CPI data, We did have this sort of 126 level trading range, which we'd seen sort of since December. We broke down through there, and then we broke down again on Friday with that dollar strength really. Then retail sales yesterday down to a 5-month low at 124.05. So yes, just a bid on these stickier CPI figures that we've seen this morning, but potentially this could be just be bullish consolidation before a move lower towards sort of 124 and below. We've got a major fib level of the Q4 rally at 123.64, and then the halfway point of that rally is at 124.65. Okay, I am going to wrap it up there actually. Hopefully that's proved of use to you guys. It's really good having you all on the call. I don't see any questions. I always should say, if you do have any questions about anything you're looking at, please do ask them away. But please do follow us on social media, and we shall speak to you in a couple of weeks' time. Okay, take care out there.